I recently came across this really interesting question online from a Reddit user. In short, they were wondering, should I take $200,000 and buy a life annuity that pays me for as long as I live, or should I just keep that money in GICs and draw the income myself? And here's the thing, this isn't just a one-off question. It's something a lot of Canadians have asked themselves as they move closer to retirement. Do I lock into guaranteed income and give up flexibility, or do I keep full access to my money but risk running out? In this video, we'll walk through exactly that decision. We'll look at what an annuity really offers, how a GIC ladder works, and the trade-offs most people miss, like longevity risk, inflation, and even the tax impact. Whether you're already retired or just a few years away, my hope is that by the end, you'll have a clear framework to decide which option fits your situation best if this is something you're considering, and even how mixing both strategies might be smarter. If you're new to my channel, welcome. I'm Jacqueline Ozdemir, a financial advisor here at Ferguson Financial Planning of CI Asante Wealth Management. I work with clients who are trying to make smart choices around retirement income, things like pensions, dividends, and decisions on whether to rely on products like annuities or keep more control with tools like GICs. And I'll tell you, this question comes up more often than you'd think. So in today's video, I'm going to break down this exact decision. Should you lock in guaranteed lifetime income with a life annuity or keep flexibility with a GIC ladder? We'll start by looking at what's really behind that choice, what risks each option carries, and which ones they do and don't solve for. Then I'll explain how annuities actually work, how GIC ladders compare, and finally, what a blended strategy might look like to balance both sides. By the end, you'll have a clear framework you can apply to your own situation. And just a quick reminder, if you find this video helpful, please hit like, leave a comment, and subscribe so you don't miss future videos. All right, let's dive in. Let's start by laying out the situation, because this context is everything. The Reddit user is 55 years old and is thinking about retiring. They've got a defined benefit pension that gives them about $14,000 a year, plus roughly $45,000 in dividends from investments. So before doing anything else, their baseline income is $59,000 a year. But here's the wrinkle. They've also got $200,000 set aside. And the big question is, do they park that $200,000 in a lifetime annuity, which right now, based on current rates, is guaranteeing just under $12,000 a year for life? Or do they keep it in a ladder GIC with maturities for the next 1 to 5 years, GICs paying about 2% and just withdrawing what they need? Why is this such an interesting crossroads? Because it highlights one of the deepest retiree fears, which is running out of money too early versus locking up too much capital and not being able to touch it later in life. There's a balancing act between certainty and flexibility, longevity risk and inflation risk, and security and legacy. Most Canadians preparing for retirement face this tension, whether it's with annuities, GICs, bonds, or a mix of all three. So here's what's at stake. If they buy the annuity, they get guaranteed income for as long as they live. No matter what happens with markets or GIC rates, they'll always see that, around $11,500 deposited to their bank account. If they take the GIC path and assume a conservative 2% rate of return, stretching $200,000 to fund roughly $11,500 a year, will last about 18 years. After that, that income stream ends. And this decision matters more than ever because people are living longer. The average Canadian who hits age 65 today can expect to live another 20 years on average, and many stretch well into their 80s or even 90s. Longevity risk, which is the risk of outliving your money, is very real. At the same time, inflation eats into fixed payments. $59,000 feels comfortable today, but without inflation protection, that same income might feel tight in 15 or 20 years. So the real issue here isn't just annuity versus GIC, it's how do you balance long-term income needs with today's flexibility? Well, let's unpack what each option actually delivers. So let's talk about annuities. At their core, they're pretty simple. You hand an insurance company a chunk of capital and they promise to pay you a set income for the rest of your life. In this case, putting in $200,000 earns a payout of about $11,490 a year, illustrative of a single life annuity with level payments and no guarantee period. That's guaranteed until death, but features like indexing or guarantee period will change the quote. Now, the beauty of an annuity is it completely eliminates longevity risk. If you live past 75, past 85, past 95, those payments just keep coming. You don't have to constantly guess how long to make your money last. It's like buying a personal pension, but here's the catch. That money is gone once you buy it. You can't pull it back out for emergencies. There's no lump sum for heirs unless you add special riders, which usually shrink the annual payment. In other words, you're trading liquidity and legacy for security. Another issue, these payments aren't always inflation adjusted unless you pay extra for that future. And for this individual, the payout quoted is fixed. $11,000 a year sounds steady today, but fast fast forward 20 years at even 2% inflation, that payment will buy significantly less over time. Like the way a $20 bill used to cover dinner out, but today barely covers a coffee run for the family. From a tax perspective, non-registered prescribed annuities blend return of capital plus interest, so the taxable portion stays level and typically smaller. In registered plans like an RRSP, a RIF, a LIRA, or a LIF, annuity payments are fully taxable when received. This matters for old age security. The 15% recovery or clawback starts when net income exceeds about $93,000 in 2025. So loading on too much taxable income could also trigger a reduction in your old age security. Annuities shine most when someone is less concerned about leaving money to children or grandchildren and more concerned about ensuring their own cash flow. They're also best for people in average or good health who expect to live a long time, because the longer you live, the more the math tilts in your favor. Think of annuities like buying insurance against living too long. You're paying for certainty, not necessarily for maximizing return. And that certainty for many retirees is worth more than flexibility. Now let's compare this to the GIC, a guaranteed investment certificate, which are generally viewed to be very safe in Canada. You loan your bank money, they promise to pay you back with a fixed rate of interest after a set term. In this Reddit example, they assume a 2% return, and that's about what we've seen at times for shorter term GICs, though the rates do move over time. Right now, depending on the bank and the term, you can find GICs paying more than that. This adjusts the higher GIC rates that are actually available. But for argument's sake, let's work with the 2% number since that's the conservative assumption they used. So if the individual put $200,000 into a ladder in GICs and withdrew $11,490 every year at 2%, the money would last for just over 20 years. At age 75, the account would run dry. This is the flip side of annuities. With GICs, you maintain access to your capital once the GICs renew every time. If you need an emergency medical procedure or want to help your kids with a down payment, once your GICs have matured, you have the funds to tap into. And when you pass away, anything that's left goes to your heirs. But the big risk? Running out early. If you live into your 80s or 90s, which again is increasingly common, then once the GICs are drained, that source of income totally disappears. You're back to relying fully on your pension and dividends, which may or may not keep up. That's the longevity risk you carry when you stay in self-directed fixed income. There's also interest rate risk. GIC rates fluctuate. 2% is conservative, but a sudden drop could mean your ladder rolls into terms that pay even less, shrinking the income you can reliably pull. Conversely, if rates rise, you might do a bit better than expected, but you can't build a plan on unknowns. Taxes are another point here. GIC interest is taxed at your full marginal tax rate when held outside a registered plan. Unlike dividends, which are eligible for tax credits, or capital gains, which get favorable treatment, GICs are the most heavily taxed form of investment income. That makes them less attractive in non-registered accounts. However, if those GICs are held inside a TFSA, the interest is sheltered from tax altogether. That's why structure matters. So for someone looking at GICs versus annuities, the real trade-off is flexibility and legacy versus guaranteed income for life. GICs keep your options open, but the clock is ticking. The annuity closes the door to accessing capital, but removes uncertainty about how long you'll be supported. So let's put the two side by side. With the annuity, you're guaranteed roughly $11,500 a year in this example for as long as you live. The break-even point is around 17 to 18 years, depending on features and interest rates. That's when the total payouts hedge up to your initial $200,000. If you live well into your 80s, you win by collecting far more than you put in. If you pass away early, the insurance company keeps the balance. With GICs, using a conservative 2% assumption, you can pay yourself that same $11,490 every year, and your funds stretch about 20 years. Past that, nothing. The upside with GICs is you could stop withdrawing at any time, change your spending, or leave less money behind to your heirs. So, which is better? It depends on your priorities. If you absolutely want cash flow, guaranteed for life, no matter if you live to 100, then the annuity wins hands down. If you value flexibility, want to keep your capital liquid, or care about leaving money to others, then GICs might be a better option. Neither solves inflation risk though. Both lock you into a fixed nominal dollar stream. At just 2% inflation, the buying power of $11,000 is halved in about 25 years. That's why it's common to mix these with other investments that have more growth potential, like equities, to help hedge against inflation. Taxes tilt the decision too. GIC income is heavily taxed if not held inside a TFSA or RRSP. Annuity income is fully taxable as well, but with prescribed annuities, part of the income is considered a return of capital, which lowers the taxable portion. That's where some annuities can become more efficient than people assume. All All this shows why the answer can't be just one or the other. Life isn't that clean, which brings us to a better path. Here's where it gets interesting. You don't have to pick just one. You can split the 200,000. For example, you could annualize 100,000, locking in about $5,700 of lifetime income. That covers essential basics. Then you keep the other 100,000 and a GIC ladder or other fixed income. That pool stays a bit more flexible, a bit more accessible, and part of your estate if unused. This hybrid approach smooths both sides of the problem. You've got guaranteed retirement cash that never runs out, plus capital for emergencies or legacies. Just remember that most GIC providers will not let you access your capital until maturity. And if by the time you hit 75, your health looks good and you're still active, you could always annuitize a portion of the remaining capital from your GICs and do it then at a higher payout rate. Insurance companies pay more for annuities at older ages because the math turns in their favor. Another option worth mentioning is a deferred annuity. You could buy at 55 and have it start at 75. So your GIC ladder covers the early years and the annuity kicks in later with lifetime payments. If you're using registered money, this is an advanced life deferred annuity or ALDA. Payments can start anytime up to the end of the year you turn 85, and you can allocate up to 25% of qualifying registered accounts. And there is a lifetime dollar cap, which is indexed currently at $180,000 in 2025. It's a simple glide path to cover both short and very long-term risks. There's also something called an insured annuity strategy. That's where you buy an annuity with non-registered funds, then also buy a life insurance policy of the same amount. The annuity secures tax-efficient income during your lifetime, while the insurance replaces the capital for your heirs. It's a way of getting both lifetime cash flow and estate preservation, wrapping around some of the downsides. These creative mixes highlight something important. Retirement income planning isn't about finding the silver bullet. It's about stacking tools to help solve specific risks: longevity, inflation, tax efficiency, liquidity, and legacy, each with their own weight based on what you personally value the most. So how do you actually make a decision without second guessing yourself? The way I frame it is step by step. First, identify your risk tolerance. In plain terms, do you lose sleep thinking you'll outlive your savings? Or do you lose sleep thinking your capital is locked up forever? Knowing which fear is stronger points you towards annuities or GICs. Second, consider your health and family history. If longevity runs in your family, annuities might look a little bit more attractive. If not, the flexibility of GICs may suit you better. Third, calculate the income floor you need, your baseline expenses that must be covered no matter what. If your pension and dividends already handle essentials, the $200,000 doesn't need to be maxed for security. It can be more about flexibility or legacy. Fourth, factor in tax. Add up expected income and see if additional streams push you over OAS clawback threshold, which in 2025 starts around $93,000. If you're close, you may want more flexible options like GICs and TFSAs or partial annuitization with prescribed tax treatment. Fifth, weigh legacy goals. Does leaving $200,000 or whatever's left of it to your children or charities matter? If so, GICs or insured annuities might make more sense. And finally, inflation. Fixed incomes shrink over time. That's why many advisors recommend keeping some part of your portfolio in growth assets, whether equities, real estate, or inflation-linked products. The worst mistake is thinking either annuities or GICs alone will fully protect you for decades. At the end of the day, this isn't about which instrument is better, it's about which set of trade-offs you're comfortable living with. And for many people, blending them in a way that matches both personality and math is where financial peace really comes from. So the Reddit user asked, annuity or GIC? The nuance is that either could work depending on what keeps them calm at night. But the real answer is often a little of both, structured smartly with taxes, inflation, and legacy in mind. That's how you create retirement income that lasts and feels like it fits your life rather than your life having to fit the product. So let's bring this full circle. We've looked at what annuities give you. Guaranteed lifetime income, freedom from guessing how long your money needs to last, but no ability to pull funds back once you've committed. And we've seen where GICs shine: flexibility, access to capital, and the option of leaving something behind, but with the risk that your income runs dry if you live longer than expected. The real takeaway: this isn't about picking a winner. It's about matching tools to the risks that matter most in your life: longevity, inflation, liquidity, taxes, and legacy. For some, security is priceless. For others, keeping control of their capital feels more important. And for many, a thoughtful combination of both ends up striking the best balance. The implication here is powerful. The wrong structure could mean running out of income too early or locking up wealth you later wish you had. But with the right mix, you'll know your essentials are covered while still leaving room for flexibility, growth, and even legacy goals. At the end of the day, retirement income planning isn't about certainty versus freedom. It's about creating a structure that genuinely fits your life. So how would you weigh it? Would you lean toward the guaranteed income of an annuity, or does the flexibility of a GIC ladder feel more comfortable? Drop your thoughts or questions in the comments below. I'd love to hear how you're thinking about this trade-off. And if all this has you wondering what the right balance might look like in your own situation, that's exactly what I help people figure out. There's a link in the description where you can book a no-pressure discovery call, and we'll walk through how these strategies could fit into your bigger picture. Also, if this breakdown was helpful, make sure to hit subscribe and turn on the little bell so you don't miss the next video. We'll be tackling more real questions just like this so you can see how the theory meets real life money decisions. Thanks so much for watching, and I'll see you in the next one.